partnerships, because I think partnerships can be, and I'm saying that very slowly, they can be really beneficial. They can also be a thorn in your side. But let's talk about the happy days part of partnerships.
Yeah, my father always used to say, partnerships, sinking ships. Yeah, so on that note, I'm going to say, do your homework well, know your
Mm,
partnerships, have things stitched up legally, and make sure that a partnership is a genuine partnership and not a partnership where you are doing all the work and putting all the money in and your partner is just riding the wave, because
mm,
we've had a couple of experiences with that. They are not good. So you really need to get your legal team in this, make sure that things are stitched up. Do not try and cut corners, particularly if you don't have a 10-year relationship with your partner and you
mhm.
know them inside and out. Okay. People change. Where there's money, there's greed, there's
Emotion.
changes, there's,
Mm,
when things go pear-shaped, suddenly you see a different side of people. All right.
mhm.
So that's just a little warning around partnerships. When partnerships are really good, and I've seen some amazing partnerships recently. In fact, two young guys went to school together, grew up together, their families knew each other. They went into business together, sort of organically, and now they've gone into purchasing properties together. And it works really, really well because they have established their ground rules,
Mhm.
which doesn't necessarily work for both of them, but they both benefit from those
Yeah.
ground rules. So it really is a balanced sort of thing that's going to work. And
Yeah.
a perfect partner would be where another investor or group of investors allows you to combine your resources. So I'm thinking of like joint ventures as well. When you do a joint venture, you really are going into partnership with whoever is running that joint venture. Okay. And there's various different contributions, whether you're contributing your time, your expertise, whether your capital, and all of that needs to be balanced out. So if it's somebody's time, how much is their time worth per hour versus if you contributing your capital and they're contributing time, how do you balance that out?
Mm,
You
mhm.
know, so there's a lot more that goes into it. If you're contributing your time, you really got to put a number to it that equates to capital. And or if somebody's putting their capital in, are they putting 60%, 40%, 90%, who knows, whatever
Yeah.
it is, just give it some sort of balance so that it's very, very clear. Okay.
Mm. One of the things that my accountant said to me years ago is get your divorce papers in place while everyone's still happy. Because when people are going into partnerships, that's always the most exciting time, right? They're excited, they've got a new
Yes.
partnership, this is going to be amazing, we're so happy. But that switch can flick really, really fast, and trying to sort it out once the switch has flicked is actually really difficult, because then all of a sudden it's like you're bashing heads. So it's just so much easier to get all of that down on paper, work through every scenario while everyone's happy so that it's super clear. And I think that's probably one of the best bits of advice he ever gave me.
You're 100% right. In fact, while listening to your story, I was thinking about when I got married. My lawyer said to me, "Let's discuss the divorce." And we were like,
Yeah.
"What?" And she said,
Yeah.
"Absolutely. We're going to discuss the divorce. What happens in the event of a divorce?" So, sorry, that's just going down another rabbit hole, but it's you're
Yeah, but
100% right.
it's
Because a
yeah,
marriage is a partnership, really.
totally.
And
Totally.
you've got to look at the worst case scenario and what that looks like, how it would play out before you actually have the fun and get married. So yeah, look, I mean, it's a great strategy. It reduces your risks, your financial risks, allows you to leverage. So instead of buying a property for 2 million, you could buy a property for 5 million, you know, by having partnerships. But again, they got to be really good, solid partnerships to do that.
Yeah.
It's a great strategy, get it
Yeah.
right.
Absolutely. Now, the next on the list is assume an existing mortgage, and I'd love you to share what this is and how is this different to subject to financing.
Okay, so slightly different where you are taking over somebody's mortgage and the remaining loan. So they're out completely. Generally, you would take it over at the same rate, and there wouldn't be much of an incentive over here. Circumstances might be different. So it might be, I'm thinking of one instance in particular where husband and wife, husband used to run the property, the business. He passed away quite suddenly. She was lost. She didn't know where to go and what to do and how to do
Mm,
it. And the buyer came in, took over the mortgage, continued with the payments and on the existing terms. So the benefit of that is it's fairly quick. It helped her out straight away. She was totally relieved that that burden was off her shoulders, and he got himself a good opportunity. It was pretty market relative, so it wasn't like a massive windfall, but it was a good opportunity for him to get into the market without having to pay anything realistically. The advantage and the difference with this one would be that you're not paying a bond or a deposit. You don't have to put money into the deal. You're just helping somebody out and taking over their responsibilities in their mortgage.
I want one of those. That sounds good. That sounds like a super easy way to do it, to be honest. I could be missing something here, but my brain's going, not dealing with having to organize lending. That sounds fantastic.
Well, again, these are communications. These are
Yeah.
really, if you're dealing with an agent, pick the agent's brain, find out from the agent why they're selling. That's the easiest questions. One of the first questions that I always ask is why they're selling. What are the
Mm.
circumstances? Who are they? Is it a couple? Is it a singular person? Why is she selling? She's had the property for 20 years. And then you find out, oh, her husband died. Oh, what were the circumstances? So it's asking those questions. It's not attacking somebody, It's just in general conversation so that you find out more. And then would they be open to assuming the mortgage?
Mm.
They can either say yes or no.
Absolutely. If you don't
Yeah.
ask the question, it's always no.
Yes. Yeah,
Yeah.
absolutely. So whatever you're not, what are you losing?
Yeah, exactly. Let's talk about equity sharing. Most of
Okay.
us know what equity is. Can you break this strategy down?
Okay, so this could be similar to partnerships, but generally equity sharing is when you have quite a couple of people that are contributing equity, joint ventures, where investors provide a down payment in exchange for shares of equity in the property. Um, let's call this a syndicate. Okay, which is probably the more used term for equity sharers, where somebody goes out and finds a great deal, finds a good property, and you find investors that come along and buy shares in that deal, and you've got one investor in particular who knows how to run the deal, who monetizes the deal, adds value, and everybody gets paid out and they get equitable shares when the property's sold.
Mm-hmm.
Very common. There's REITs, real estate investment trusts that do this a lot. There's private lendings. There's a lot of private developers that do this. And it allows the developers to grow a portfolio and take those shareholders with them. So often what happens is you'll do one deal, it works out well, and maybe the developer goes on to a second and a third and a fourth deal, and you like and trust the developer. However, be very careful. I always say do not overinvest in one developer only. Spread your eggs.
Mm,
Because just like the marriage and divorce story we were talking about, you never know what
mm-hmm.
happens when the market changes, when circumstances change, and suddenly they need to get out fast.
Yeah.
There have been some pretty scary stories that have been happening in Melbourne, where people have been doing this for quite a long time, and suddenly the developer says, "Oh, no, too big for me, going bankrupt," and everybody's lost their money.
Oh, wow.
Yeah, so really do your homework. Okay.
Mm,
But it does allow you to kind of acquire a property. I call it third party acquisition with very little money down, and you share in the financial rewards.
sounds
So,
good.
yeah. It's a great way if you don't want to get your hands dirty, basically. It really is. Another way you can call it is armchair investing. So there are many names for the same thing.
Uh-huh.
Yeah.
Armchair investing. Very
Yes.
nice. What's the next strategy, Mish?
We've got here using lines of credit. Okay.
Hmm.
So this is probably one of the most common ways of investing at the moment. It's called a HELOC, which is home equity or line of credit, where you've now what's happened in around Australia over the last 16 to 18 years is properties have just gone crazy. So we
Yeah,
all
haven't
know,
they just? Mm.
yeah, our properties have doubled and quadrupled in value. Get your property revalued, do a line of credit or an equity drawdown. You use that money to go and buy a commercial property. So this is
Hmm.
the most common strategy that we see most people are doing at the moment. And I think the biggest thing to look out for is make sure that you can afford it. So in the event that interest rates go through the roof, that you can afford to pay for both. Because you don't want to
Hmm.
be losing your home and you don't want to go losing your investment property if you put a whole bunch of money in there, a whole stack of money.
Yeah.
But that's what most people are doing in the current market. Just do your homework and do it right.
Totally. I did see a story just a couple of days ago with a young couple in Melbourne that have gone bankrupt because they didn't do the homework. And when I looked at the numbers, I was like, that was never going to work. Like you really did not run those numbers.
What did they
You-
do?
well, they just did not pay attention to what the mortgage repayments were going to be. And then they were
Uh,
blaming everyone under the sun. I'm like, but you knew that right at the beginning.
yeah.
Like, how did you
Yes.
miss that? You actually
Yeah.
have to pay it off.
Yeah, of course. You've got to go into things with your eyes open. And particularly in the current market, which is very volatile, yes, the interest rates are holding and holding and holding. And we don't know what is in the future. But I mean, if those interest rates go up to 10%, can you afford it? So
Mm,
when you're doing something like this, that's the question that you want to be asking yourself. Is if the interest rates do go up to 10% for whatever reason, I'm not saying that they're going to, but I'm using that as a round figure. Can you afford it? Can you afford
yeah,
your home and can you afford your investment?
yeah, totally.
Yeah. So
Alrighty, let's move on to sellers' existing equity.
this
Talk
again
us through
is
this one.
very tricky one. This is kind of often done in a slow market. At the moment, we're in a very hot market, but in a slow market where a seller really wants to get out and they're not desperate for the money right now, you can negotiate with the seller where you're using the existing equity in their property to pay down almost like they're paying themselves. It's almost like putting a second mortgage on the property or the structure, and you're using a promissory note, which means that you are, again, you're doing this legally. And a promissory note is a promise to the seller that you're going to pay them X amount within a certain period of time. Okay. Why would they do this? Because let's just say it might be a more regional property and it's been sitting on the market for 24 months, 2 years, and they can't sell it.
Uh,
And you don't have the finance to sell it, but you've got the vision to maybe turn it into a Super Bowl or whatever it is. You come along and you see the advantage of, or you come in with different creativity. We've actually got a property like this that we're working on at the moment. It wasn't a seller's existing equity. It was just an ordinary deal. But the buyer purchased the property. The town that they purchased in, it's a regional town, and the town has just exploded. It's just growing
mm,
exponentially.
wow.
So it would have worked perfectly well for that sort of situation where you can see. Now, often what happens is you can't see the wood for the trees. So for the seller, if they've lived there and they just see things, on a day-to-day basis, they can't see the wood for the trees. They wouldn't see those opportunities. You come in as an outsider, you can see those opportunities and get educated so that you know what you're doing, run your numbers, do your data, and here's an opportunity. Okay. So the benefits of this is finding a highly motivated seller And it's a very, very, very fine-tuned negotiating that you'd have to do. Very difficult to do this through an agent, best to do it directly with the seller.
Mm-hmm. All I can think of the whole time you're talking about this is building the field of dreams. Like, the Kevin Costner movie, Build It and They Will Come. That's all I could think
Oh,
about.
gosh, because I mentioned the Super Bowl. Yeah,
Yeah.
absolutely.
All
Yeah.
right. No, the next strategy you've got on the list, I've actually not heard about, Mish. So I'm looking forward to hearing about this one. And this is wraparound mortgages.
Yeah, so this is not very commonly done. Again, all of these, and I'm going to say it 1,000 times over, these are negotiations, and you've got to have a really open-minded seller to do something like this, where the buyer creates a new mortgage that wraps around the existing mortgage. So the new mortgage would be at a higher amount so that you can pay the seller. So the seller continues to pay for their mortgage, but now you're paying the seller enough to pay for their mortgage and more. And the addition that you're paying them is basically paying that property off. So let's say if you're in a good cash flow situation and you really like and want their property, and they don't necessarily want to sell it, or for whatever
Mm,
reasons, maybe they want to run the lease out or whatever it is, that they continue to hold the loan, and it buys you time and it gives them whatever they need. So this is really a time versus money strategy. Okay. And the buyer just carries on paying for their mortgage and a new mortgage. Very tricky to do in finance. So you need a very, very well versed financial specialist to do this for you, or a mortgage broker to
hmm
do this for you. There's got to be flexible terms in it. And and the reason why you're doing this is you want to get to the point where you're not putting any money down. So it's a no money down deal. Um, and a lot of negotiation with your lawyers, with your financiers, your brokers, and the seller.
mm,
So you
mm.
know how I always say, um, commercial real estate is really not a one-time pony. It's a
Sport.
team sport. Thank you. Edit that, please.
We got there.
It really is a team sport, and you've got to have a good, strong team behind you, and you've got to have all of those professionals behind you to make sure that these kind of deals done. All of these deals, I would say, you need a good, strong team to do this. Don't try and do
Yeah,
this alone.
totally.
Yeah,
I
be
definitely
silly.
do not. Yeah, absolutely.
The other
Um,
one is quite an interesting one. Again, done in sort of I'd say more regional. Very difficult to do these in cities. You know, a lot of
okay.
people that I speak to listen to this stuff, hear about no money down deals, but they want to do this in the metros. Guys, in the metro, people are not interested because there's such a glutton of buyers that you'll never get
Yes.
any of these strategies through. So these
Yeah.
are creative strategies that are cherry picked outside of where most people are not looking.
Mm-hmm. Mm-hmm.
Um,
Let's talk about trading or bartering because I think that's where you were leading into.
yeah, yeah.
So tell us about this.
Okay. So I've worked with a client that we did one of these as well. It was a lot of fun. What you're doing is you're offering the seller, the vendor, something of value, something that they would value instead of the money down. Okay. So this could be another property that perhaps they're interested in. It could be a car, it could be services, it could be something that the vendor values. And it's a very, very creative way to satisfy the seller's needs without using any cash per se. I'll tell you a quick story. We were busy negotiating a deal, and the buyer, the price was changing and the deal was changing, and the buyer couldn't come up with it. And he had I think he was driving a Lamborghini at that stage. And he said to me, Mish, but I've just bought it. And I said to him, well, mate, buy another one, sell it, use it, offer it, buy another one. Anyway, we ended up doing a whole deal where he used his Lamborghini as the down payment, and he got
Ah,
himself a property. And I said to him, mate, think about this. You're paying interest on this Lamborghini. it is not going to value as much as what a commercial property is.
Uh-huh.
He used the car, we bought the property, and within 18 months, his property had gone up about 20%, and he probably had
Wow.
three Lamborghinis on his floor by then. I didn't ask.
Oh, whoa.
But there we go. So
I love it.
be creative about it.
Yeah,
It was a fun
totally.
deal.
That
We had a lot of
sounds
laughter.
super fun.
Yeah, we had a lot of argy bargies and just like you said, you're a deal maker. Same here. I love these deals. Bring them to
Yeah,
me.
because they're creative, they're fun, and I think that's what it's about. It's like what it's about creating fun out of the deal, and that to
Yes.
me sounds like a fun deal.
Yeah, and it's win-win for everybody. Everybody comes out
Yeah,
smiling.
yeah. And it's a good story. That one's a really good story.
I can't remember if it was a Lamborghini. He used to change cars all the time, and it was a Lamborghini, and then it was I can't even remember the names of all of them, but
Yeah, yeah.
they were always sports cars. So
I
that's
love it.
that's his thing. It was fun.
I love it. Wholesaling.
All right, so wholesaling is quite interesting, and again, you really need to be in the real estate market to be finding this. If you find a property that's under contract, and let's say it's at a discounted rate, and the contract. So
Yeah.
if you find a deal that's under contract and you can see that the deal's going to fall over, you come in, you can see that it's a great deal, and you manage to get the seller to sell the contract to you. So they're selling the contract to you, all right, for whatever reason that they can't get out or they can't get their finance, and you pay them a fee. Um, and you know that you can sell that contract to somebody else at a better rate. So does that make sense? So in other words,
It
you don't
does.
actually ever go to you never go to contract on this one. You just purchase the rights to the property. You paying the vendor who is not he's not the vendor. He'd be under contract, so he'd be liable for the deal if it fell over,
Hmm.
financially liable. So you coming in, you're solving the problem, and you're finding another buyer to purchase the deal at a higher rate. So you're basically clipping the ticket.
Yeah, yeah.
Okay, so you're doing a little bit of working in between. It's joining the dots. It's all about joining the dots. It's about finding somebody who doesn't want to go ahead with their deal for whatever reason. They can't afford to get out of it, and you giving them a solution and you clipping the ticket along the way.
Mm, yeah. So this is, I would think that would be a great strategy for someone that's quite well connected.
Very much for somebody who's well connected. Very much you're going to find somebody who's gone to contract, doesn't know what they're doing, got themselves into a mess, and you know how to solve the problem.
Yeah, yeah.
And
Love
you
it.
can make a little bit of money along the way. Okay.
All right, last strategy, Mish.
Hacking.
Hacking, not biohacking. We're not getting
Uh,
some a whole heap of vitamins. So take us through this last strategy.
very interesting name, hacking. I think we've got different names in Australia for the strategy, but basically it's a multi-tenanted property. You occupy one of the units, so that's you're getting paid rental income, which is covering your mortgage, and effectively it's allowing you to occupy rent-free and potentially acquire the property with no money down. Okay,
Mm,
so it's putting your own business in. In Australia, we do leasebacks.
hmm.
So it would be pretty similar to that, where you leasing a proportion of the property in order to sell it or purchase it, whichever side of the fence you're on. And that allows finance and allows you to occupy and take over the property over a period of time,
Mm,
whatever that is. It's a very practical way of investing in real estate, and it's minimizing your risk to a certain extent. Again, you need to be connected, you need to know how to do this, and have the right professionals on your side.
mm. Yeah, what I've hit, there's 14 amazing strategies here, and it's one thing to know what you're doing. But with every single one of these, I know there's a risk. So can you, like,
Massive.
what do you want to talk about in regards to the risks? Because I think that we've spoken about a lot of rewards, but we have to look at that other side as well.
Very much so. And Sam, if you don't take the risks, you're not going to get the big rewards. So
Mm-hmm.
the first thing you've got to look at is, who are you? What kind of personality are you? Are you a high risk taker, or you just want something vanilla? If you're the vanilla type of investment, you don't even want to look at these. If
Yeah.
you are gung ho and prepared to take the risks, because these strategies could bite you hard. You really need to understand that you need assistance, you need professionals, and you need to pay for
Yeah.
people to assist you and to get these kind of deals over if you don't know how to do them. So they carry a very high level of risk, and essentially make sure that you proceed with the right team. I've said it before, experienced lawyers, financiers, guidance helps. There's a lot of groups around Australia as well that you can join, property investing groups that you'll learn quite a lot about. But make sure that you seek guidance from professionals and you truly understand what those risks are and how to structure these deals. That's the most important. Understand, read your contracts, know exactly what every single clause means. I've often found in my experience that these contracts can take a long time to get to where you're both in agreement and you have something signed. Um, 3 months, 6 months, it can go on because that contract can go back and forward, and you're going to be paying your lawyers to do that. Make sure that you are 150% all over that contract before you go and sign it. Okay. And yeah, it's high risk, but it can give you very significant rewards. Be prepared to go.
Yeah, totally. Very wise words, Mish. 14 amazing strategies that we've talked about today. I love talking about this stuff. I've learned lots, and I think there's so much opportunity for people that do like to get a little bit creative and think outside the box. And I think that if you come in with the right intention, i.e., not just what can I get, but how can we create something that creates a win-win for
Mm.
both parties? I think some of these strategies are fabulous. So, Mish, thanks for taking us through them.
Absolutely, Sam. Lovely chatting to you about it. And I'm super excited because I've been wanting to talk about this for quite a long time. I get so many questions. But guys, be warned, roll up your sleeves. Sam, thank you very much. I really appreciate it. It has been a great year of podcasts, of topics. And I want to thank you for being my partner in crime in doing these. Um, Always love having these conversations with you. And let's have a look at what the future holds.
Absolutely. Well, thanks for teaching us so much. I came into the year knowing nothing about commercial real estate. Now I know a little teeny tiny
Uh,
bit. So, so thanks for having me. It's been an absolute blast.
Thank you, Sam. See you on the next one. And thanks all our listeners. If you like this, please go ahead and give it a like, give it a thumbs up, and reach out.